right, hi everybody. This is the first episode for Voped, my podcast. If you missed the personal intro, you can always look that up. I'll have it on YouTube or BitChute or the Patreon channel or any of the other places that you can find it if you want to know a little bit more about me. I figured I would do this one kind of outside. It's a fairly breezy day, and that always kind of messes with the vocals and sound recording. So if I'm half indoors, half outdoors, I get to enjoy the outdoors because it's a beautiful day and I love the outdoors. And if I'm half inside, then hopefully the sound won't be too bothersome and you can still hear me speak. Since I wanted to address things, as I said, from a kind of a financial and economic standpoint and try to make it a little bit more layman's, I figured I would start off with commentary on retail trading and equity, since so many retail traders have fully bought into the buy the dip philosophy. If you don't know what that is, it's been kind of the same thing for a long time. When a stock shoots way down, way below where it has been at, I think the common belief is that it's going back up, so buy it way down there and it'll go back up to where it's been in the past. God, I really, talking about finance and the markets right now is really, really difficult. The markets don't behave at all how they have been the past 2 decades, and they didn't really behave all that normally the past 2 decades. But when somebody says that they've been investing or what have you for the past 10 or 15 years and they know what to do, they don't know what to do. It's just flat out. There is nothing historically available there's nothing available in historic data that could lead you to believe where we're going in the future. There's nothing in your technical analysis really that could lead you to believe where we're going. Or fundamental and value analysis. If you don't know the difference between those, so technical analysis, if you've seen the guys who have their running charts and all the bar graphs, and you'll have green bars and red bars, and whether it's going up and down, and they'll draw all their lines on it. Normally what they're looking for is they're looking for trend lines, and they're looking for where institutional investors enter in and leave the market. And so they can kind of figure out, where the marks are, where it's going to bottom out, because that's where the institutional investors will come in and buy, and when it peaks, that's where they're going to be selling, and you can kind of see with your trend lines kind of where it's closing in at peaks or valleys, and kind of how it's flowing. If you're running fundamentals and value, you're really looking at the financial statements for the company, and you're trying to figure out where they're running with future earnings. And value investing, there's the big difference between the two, is kind of where I'll start today, and I'll run into equity. And technical traders, when they're looking at the flows of the market, that's your day traders. They're trying to figure out where they can buy it at so they can sell it later on at a higher price. They're not looking to hold it, usually maybe not more than a week, maybe 2 weeks. Sometimes I guess you can run longer, but that's not really what the main purpose is. They're just looking for a quick appreciation in the asset and then looking to get rid of it. If you're value investing and you're actually looking at the financial statements, generally speaking, you're actually trying to look at future cash flows and what's available to the shareholder in terms of dividends. And that's kind of where equity plays into it. Now, if you're running equity, what that is, just market value of the equity, shares outstanding times whatever the price is for the share. That's called your market cap, and that's your market value of the equity that you're trading. Where that comes from, or the idea of where it comes from, is supposed to be the present value of all your perceived dividends down the line, or basically the net earnings down the line. if you don't know how that works, when you purchase equity in a company, ideally you're purchasing a piece of that company. And by a piece, I mean anything that's above and beyond what their costs were to actually produce, distribute, sell the product, and they come out, after paying off debt and everything else. That end value there, it's kind of like when you do your taxes and you end up with net income after you've deducted everything. Same thing for the company; they just do it for a product. But you own a piece of that, and so they show that as earnings per share, and that's just simply whatever those net earnings are at the end divided by shares outstanding, and that's your piece that you actually get. So if you take those, and typically companies will do future earnings projections, and they really do that. They look at the market. They look at what they're spending. They look at any way that they can cut costs, or maybe invest in technology to cut costs, or really streamline their product, new product lines, product development, any costs that go into it. Perhaps even look to trim their fixed costs if they can. And fixed costs are usually what they call PP&E, which is property, plant, and equipment that is used in there. And a lot of companies had went to an asset light type balance sheet to do that, and I'll address that at a different time. For right now, you just know that they're looking to trim the costs that go into producing that product to try to maximize the earnings on the end. And so in normal times, you can see how a market runs. All markets run; they kind of have a cyclical nature. They're going to run up and down, just like the stocks do. Everything on a small level just mimics the big level. Certain industries will have cyclical flows. They'll be bigger at one time than another. Agriculture is a really good example of that. Obviously, agriculture, big harvest in the fall when they're selling everything, slower in the spring when they're running planting, and retail industries during Christmas, cyclical, big times there, slower at other times. You see cyclical natures in a lot of stuff. So companies see these things, and they have a really good feel of what they're going to be able to make and kind of what their earnings are going to be. And so they project out, and ideally when you're looking at whatever the equity is, you're gonna look at those cash flows, and you're gonna theoretically assume that those are going to kind of continue on forever and maybe grow at a little bit of a rate, maybe 2% or 3% or something like that, especially if it's an established company. And then you take all those cash flows and you discount them back, and that's going to be your, ideally your price. Now, the discounting method, we can get into that, but I mean, that gets a little bit complex. Just think of it this way. If you're able to invest your money in a CD at 2%, and you needed a certain amount at the end of the year, you'd be able to figure out, well, how many CDs do I need at 2% to get that total amount at the end of a year or 5 years or whatever? Well, I mean, it works in reverse too. If that's where you were at the end of that year, well, if you took that amount and took it backwards by that interest rate, that would bring you to the present value. That's how present value works. But anyway, that's where ideally the stock price should be, and you can figure it out that way. And so it's all based on those future cash flows, and rightly so, because that's what, as a shareholder, you're entitled to. Now, where this market has gone has completely blown out of whack, and this hasn't just been right now due to COVID. The market has been out of whack really since 2001, when you had the dot-com bubble burst. Folks probably don't really remember that, but just 20 years ago, that's when the internet really kind of took off and started trying to develop an online presence for companies. Now it's commonplace and nobody really thinks anything about it, but just 20 years ago, it wasn't. And these companies, much like a lot of the companies that were doing IPOs today were way overvalued, and everybody kind of began to realize that they were never going to be able to make those earnings to make up for whatever that valuation was, that market cap, kind of like what we were talking about. And if you can't equate that, then that means you're over, you're buying way over what it's worth. Okay. And people just started getting rid of everything that they had, and the whole thing crashed. And I think during that time, it's probably Greenspan, who was in the Fed at the time. I can look it up. It doesn't really matter. Whoever was the Fed chair at the time, maybe it was Bernanke. Yeah, Bernanke, I'll bet. But they kind of opened the door for the first quantitative easing on buying of assets, that first bailout. It wasn't blatant, it wasn't direct, but it's still, that's what it equated to, and it opened the door really in 2008. All right. And it opened the door really in 2008 for when the housing crisis happened. And when they did that bailout, it actually had never really been the same since, because they did that huge TARP bailout and gave these companies all this money. And along the way, they were still doing quantitative easings and buying up assets that way. And basically, just to address that, if you don't think that they were actually affecting the market, a really easy thing that you can do is, but I've got an article, and you can look at it, just doing a reward to risk ratio and looking at, which is your Sharpe ratios, is typically, it's a fairly standard measure for whether you think a company is doing well and has a strong position in terms of earnings and volatility in its stock prices. And so the change from just the 2001 to 2010 and then 2010 to 2020 was markedly different in your Sharpe ratios. There were bump ups in earnings per share and marked reduction in volatility, and so reduced risk. And you can see that, and doing kind of a pooled t-test, you could see that there was significance in those values. And so they weren't just arbitrary, bigger during this decade than that decade. No, there was definitely something up with the values, because they were the same companies. I took the 30 representative companies in the Dow during each period to look at them. And so during that time period, they did that quantitative easing. Eventually, the money gets funneled back into the pockets of the corporations, and then the corporations use that to do stock buybacks that increase their earnings per share. And of course, it made the asset earnings, if you were holding your shares, look much better in your Sharpe ratios. And so it had a dramatic effect on that. And if you want, you can read the brief little excerpt I did. It's fairly quick. The charts, I believe I put all the charts in. They should all be scaled properly so you can see, and it's fairly evident. I didn't really go that deep into the analysis because I didn't really seem to have to. It's right there in front of you. And so now we're looking at a market where it's entirely different, because there's no amount of money printing that can be done that can change this market now. Now, the reason why this can't be financially engineered, it can't be like the 2008 crisis, because this goes into a completely different set of rules. And so this is all economics now. And there's a subtle difference between the two, but I always like to say finance and economics, those are the rules for the game, those two things right there. And if the finance and economics are the rules, then history ends up being your strategy, and they always play out that way. But anyway, so in economics, I tend to like to say everything is demand. That's it. That's why there's a law of demand. There's not a law of supply. Everything is demand. If you do not have demand, there's no point in even putting out a supply most of the time. And that's a demand for anything from goods to currency to anything else that you can think of. Everything revolves around demand. Even initiating supply revolves around demand. One of the more overlooked economists, I think, who did a demand side theory was Stefan Linder. He was a Swedish economist. I'm putting together an article for that, and because I was just fascinated by the way he viewed the world from that perspective. But basically it works like this. Say you're in an area, you're noticing a lot of people who are having trouble with their automobiles, and there is no mechanic in town. Well, you then pick up or learn the skills, you open up your shop, and you become that supplier of automotive knowledge. It's the same thing with any kind of products. If electronics makes your life easier, and people oftentimes equate like that they can create the supply, and it's not really necessarily true. If there are a lot of businesses, and say there's been a lot of financial tech and financial apps or accounting apps, but that's just simply because it cuts costs for a company, so they find it useful, and that's productivity measure. And so that supply then becomes great, and they demand that, but they always demand ways to increase productivity and efficiency. That's what companies are looking for. You didn't create a demand for your product. You just answered a call that is not always outwardly screamed at, from businesses, but any business that can cut costs and delivery from its product is going to use that product if they can, if it's in their budget, if they can show that there's a cost benefit to using it. And so you didn't create anything from there. There's too often that people believe that they can create that demand. And that's the same thing right now with the stimulus checks. They're called stimulus checks because the Fed is trying to stimulate demand, but you can't create an artificial demand, especially right now. Folks right now aren't needing anything. There's nothing open to be needed. People don't need new clothes. They might need new electronics if they're doing things for work. But right now it's basic bare utilities, food, and perhaps automobile thing, not even really gas, but just upkeep or maintenance that they have to actually drive somewhere. But even that's minimal. There's almost nothing right now that people are demanding, which is why there's an absolute shutdown for everything. But it's also not helping that with the shutdown, it's killing every single industry associated with that. And whether that's airlines or that's hotels and resorts, Las Vegas, for example, most of Florida, if you've got summer vacations and things of that nature, your Disneylands, Disney Worlds, you can't create artificial demand, especially if there's nothing there that you could be demanding with anyway. And then to top it all off, there's a lot of uncertainty. Nobody knows where anything is going. I was reading one article that deposits have grown in the financial institutions at a steady rate since the start of this crisis. Basically, all the money that went out, everybody took and threw in a bank. I mean, sure, people spent it, and you can see that there were little bumps in spending, but people threw in a bank because almost no one's like, I don't want to say brain dead enough. It gets a little too vulgar. But nobody is thinking that, hey, I know where to put this and I know what to invest in, so I'm going to throw it in there and do it. That's just not happening. You do have, of course, retail Robinhood traders, but they're buying fractional shares. You can put a couple $100 in an account, and it doesn't really even matter. Everybody else is looking big picture. Like, am I going to have a job? Is it still going to? Is this still going to be paying me what I'm used to being paid, or is it going to be reduced? Am I going to go on furlough? What exactly is happening? And that right now is what we're dealing with. And so you can't stimulate a demand for an economy that isn't open. And that's what a lot of people don't get. There's just no way to do it. But that's why everything stems from that demand. And mind you, if you don't know this, our economy is all demand-based pretty much. I've seen numbers anywhere from 60% to 80% demand-based economy. And everything else after that is our exports. And usually those exports, however, are service-related. Although we do, export a number of higher tech items and higher tech machines and so on as well. But most of our economy is based on consumption, which is why we were China's #1 trade partner. Noting that China's size allows it to be big enough to produce all of the things that all these people need. And that comes into a big part that a lot of people don't realize. So with our economy completely shut down, nobody really knowing what to do and what to invest in, but the stock market's still going up. Remember what I said about the fact that all those stock prices are supposed to be related to future earnings. So how are these companies looking at future earnings and their stock prices keep going up? Now, are you anticipating that these earnings are going to keep going up? Because I don't think that they are. These earnings are going to eventually come back to kick them in the butt, which you're starting to see now, and people have mentioned this. They're not going to be able to make money to even continue operations, let alone pay on debts that they have. Now, debt is a little bit different issue here, obviously from equity, but your firm's value, companies, if you look at a firm value, and I'm sure you've heard this, it's equity and debt. They always consider debt a good thing, but there's a reason for that. It goes into tax shields, which I can bring up and talk about later. But for right now, just think about companies trying to make money. Their stock prices are going up, but are earnings really going to go up? Now, not just the stock price from those earnings, but from those earnings, you're also looking at the ability to pay any interest payments on those debts. Okay. Now that comes out before earnings are calculated for your stock price, but nonetheless, you still need earnings to pay on your debt. Okay. And it's just like if you have a credit card in your home and you're making wages and you know what your limit is and you know that you've got to make your interest payments every single month. So you know pretty much, where you're going to be at, how much can you take out of that credit line, what your interest payments are going to be and how you're still going to be okay. But then if all of a sudden you were to lose your job and then you don't know if you can make those payments, well, that's exactly where these companies are at. And that's why they're all screaming for bailouts. But that's also why the Fed is looking to buy their bonds, because there's nobody who's going to be able to make their payments and those bonds are going to default. And so they're going to try to save that from happening, mostly from the people who already bought it up and are going to be eating that debt. And you already have seen it. Who just declared bankruptcy? Oh, Chesapeake, the energy company, originator for fracking, I believe is what it was. But the big issue with that one was the fact that, like most corporations, they're all heavily debt loaded. Unfortunately, most of that debt actually went to pay to do share buybacks, like I mentioned earlier. And you can, again, check this. If you look at the Dow and you look at shares outstanding versus treasury stock is stuff that they've purchased back. If you add them both together, those are total available shares that they have for the company. They're almost all 50-50. Almost every single company has purchased back 50% of their shares and have it in treasury stock. And so that's just another tidbit that you can look up. But So Chesapeake goes into bankruptcy or declares bankruptcy. If you're an equity holder, you're screwed, just to let you know. And that was another thing that I wanted to mention in terms of equity. I mean, granted, yeah, you're buying on future cash flows, but basically you're good faithing it. Like you're trying to buy a portion of the company, but if the company declares bankruptcy, just like if you declare bankruptcy, your creditors have claim on your assets that you have, but then the bankruptcy protection kind of like protects you from losing all of those assets, and you can kind of pay off or negotiate with them. It's exactly the same thing with bondholders and your debt with a company. If you declare bankruptcy, though, the equity portion goes out the window. That's kind of like if you need to borrow money from family and $500 or $1,000 to start up a motorcycle repair shop or something like that, and you don't make enough to pay them back, well, they're kind of out of that money unless you did some kind of a collateralized obligation or something like that. But then that would be debt again, and that's exactly what we're looking at kind of here. So you have different types of debt, and the bondholders obviously they have some is going to be collateralized, some's not going to be collateralized, and a whole lot of issues. But in the end, the guys who hold the debt, now they're rated. Obviously, there's levels of debt, and you have senior and seniors and juniors, and all the way down to preferred stock, which preferred stock is still kind of like debt, and then it's common equity down here, which they get taken out. Preferred stock is kind of a little bit like equity, a little bit like bonds, but anyway, there's a rating process to who gets paid out and when you own the debt in a company, and that's what they have to deal with, is they have to address each and every single one of the bondholders. But the equity gets wiped out. All of the folks holding shares in there, they're gone. If you've ever had a company that you kind of took a risk on and you bought some shares in, and you just saw it bottom out to zero, and this is in normal times now, mind you, it bottoms to zero because no trader who's been doing this for a long time is going to buy a company that goes bankrupt because they know it's worthless. Well, what we've been seeing is retail traders, that philosophy of buy the dip. They see it go down to where it was a really high price. I mean, some of these were, Hertz was $80 and had dropped all the way down to $1, so they must have thought that, oh yeah, it's going to go back up. And of course it doesn't, because it's bankrupt. If you're day trading and you see something like that, take 5 seconds, Google the ticker, and then put bankruptcy after it so you can see if it's due to a bankruptcy. This will save you a lot of headaches. Now, granted, yeah, if you can find other folks in there who are buying as well. I'm sure there's folks who bought Hertz at $1 and then they sold it at $6 when that flood came in. And if you sold, hey, you got out of there, you found another person to buy something that's worthless from you, and they probably didn't know it. But if you were holding the bag, you didn't get anything. And that's why before you go buying into there, just to be safe, Google it and make sure there's no bankruptcy associated with it. That's bad news. But going back to the companies, when they do declare bankruptcy, they have to negotiate with all of their debtors to see if they can still stay in operation. Generally, what they do is they trim bare bones to try to figure out if just simply whatever product or service they're offering, if they trimmed out all of the excess and just offered that at a price, could they actually generate positive cash flow? Could they make enough where they could actually start making payments back on some of these debts, possibly? And just, even in the simplest terms, could they make enough where they could pay any suppliers that of any of the inputs that go into the product? Can they pay them back? Because that's a big one too. If your suppliers don't think that you're going to be able to pay them, just because your debt holders say, oh yeah, okay, we're good with this, we may try it. Maybe you're not going to find a supplier that's going to be comfortable with that. Maybe they're not a big enough of an operator to be able to take a hit if you can't. Because everything that they're doing when they do trim down to bare bones and they're trying to figure out if they can make a profit is best guess scenario, where they think that, hey, if we have some demand in the market for our good, yeah, we can still do this. And so I believe Chesapeake actually did get bankruptcy protection, and so they kind of have all of their payments on pause right now. I don't know if all the creditors actually agreed to it or not, but they did get a line of credit, so they do have some cash flow, so they're going to be able to continue operations and pay out the necessities to keep operating. The funny thing though is that when they go into bankruptcy, most of the time those things have huge interest rate charges on them. Anytime somebody gives you money, they're expecting 17 to 20% interest. It's insane. It's just like if you've ever declared bankruptcy in your life, and all of a sudden, maybe some credit cards are looking to, give you some credit or something, or you're looking to buy a car and they're saying, oh, you can do it for 27% interest. That's the same thing for a company. They're doing the exact same thing to them, and so they're going to have to hope that oil prices come up so they can start making payments. And then maybe actually come out of bankruptcy. And that has happened. You can look through the history of some of the airlines. I think it's happened more to airlines and more other companies where they've had to go into bankruptcy protection and then manage to kind of trim costs, maybe reorganize management and so on, and then come out of it and be operational again. But like I said, these aren't normal times. You're looking at still no travel, and that's not even travel to work, for crying out loud. There's still no need for oil. There's no cruises, no airlines, no airplanes, and they're going to take the risk on this because somewhere in here I still think people feel like there's normal operations going on, and it just isn't normal operations. There is no normal cash flow, and you have to really kind of start looking at this bigger picture. A Great Depression, obviously, is what everybody brings up, or Greater Depression is what they're calling it. So it's actually kind of interesting when I tooled around to try to find information or books written on this, and even just in my spare time back when things were normal and I would run through a Barnes and Noble or something, there were never a lot of books on the shelves about the Great Depression. I don't know if it was that depressing that people didn't want to read about it. Not enough people researched it. I have no idea, but I did manage to find a couple. And then the National Archives has a couple of very short videos on it. So if you do want to look at anything regarding that, YouTube should have the National Archives videos on there, and they're actually really interesting to just kind of watch, 20 minutes or half hour or something, and it gives you an insight to what happened and how difficult the times were. But there were still companies that operated during that time, and they were able to generate a profit. But what they did was very much what happened to Chesapeake. The ones that weren't forced into bankruptcy did pretty much exactly what bankruptcy forces you to do. You trim operations all the way down to the bare minimum. And yes, that might include layoffs. That might include, closing plants, shutting down lines, trimming down products, and just going to whatever you can find demand for. And then supply that demand. And so that goes all the way back to what I was talking about earlier. It's all based on demand. If you're a company and you're offering a product, can you find the areas and the places where there is demand for your product? And that's actually the one thing that separates us a little bit from that time period, is the fact that with technology, you may be able to actually find small markets for your product and deliver it to, because oil is not as expensive, and you may be able to find trucking companies that can provide you with distribution or contract for distribution to get them to those locations so you can still make money. And so I would say try to take advantage of that. But the fact still remains is that you need to trim operations down to nothing in order to be able to manage that. And that's what people don't understand, because whether it's forced through bankruptcy or whether they do it on their own, these are coming, and this is how it's going to go. And the bailouts that the airlines are screaming for, the bailouts that other companies are screaming for, bailouts and the money they get do not matter if there's no demand, because nobody's going to be working or doing anything. And paying people for nothing doesn't work, because then eventually you're going to get hyperinflation, and I'll explain why. It's not deflation, or even you're going to get stagflation. However, it's just going to be bad. Your dollar is going to deteriorate, and you're not going to be able to buy anything. Actually, maybe I'll just jump right to that, because I think for the most part you understand that demand aspect. If there's no one there to buy, these companies aren't going to get anything. You have to lay these people off. It's just how it's going to go. And once again, like I said, if you go back and you look at video or documents on the Great Depression, you have to kind of like see what happened there to get a sense of what's going to happen here. There is no V recovery because there's no economy, because it's not open, and people don't understand that. And you can't keep printing money, because eventually there's too much money and not enough people demanding it, and that's where you run into problems. All right, so now hyperinflation, inflation, deflation, stagflation. So deflation, basically, obviously, that's prices are dropping. And they talk about deflationary spirals and so on. And yeah, you can have those, and they most of the time happen in places where there's no demand for the product, and so the product goes to zilch. And then they do cover deflationary spirals in an economy that can just keep seeping you down and down and down. I don't really think that's going to happen. What you're going to see is what we saw initially, where there's going to be price reductions in certain areas for certain goods. Primarily at first you saw in agricultural, but what ag does is dump it, and they don't let the price go down. Where else you're going to see it is real estate. And that's just a fact. You're seeing it in commercial real estate, where the prices are dropping. The other place you're going to see it in homes, because the issues that some of these cities are having during this time period, you're not going to find buyers for your homes. Nobody's going to want to go in. It doesn't matter whether you see an increase in interest to move to the suburbs. The demand still has to be the willingness and the ability. For the ability to happen, most of these people need somebody to buy their home so they can move. And if their home's in a location where they don't want to be, what makes you think that other people are going to want to be there? And so that's another issue that they have. Stagflation is inflation with no increase in demand. So once again, you go back into demand. Of course, inflation, everybody always says, oh, it's too much money and not enough goods. Well, I mean, yeah, but we've had inflation forever. When you create credit or your letters of credit, what you're doing is you're allowing somebody to have a whole lot more money than they have to bid on things, and that raises up the prices. That's where real estate kind of ballooned in 2008. You give cheap credit to people, and they're not able to really afford the payments if interest rates were to go up or something like that, and that's exactly what happened. And I mean, some of these people had mortgages on multiple homes or refis, because as more interest rates dropped, then they would refi, and they were stretched extremely thin. And that's where you have all this credit that you really can't necessarily afford the credit, because you still have to make payments on it. And eventually you're bidding up goods, and that's your inflation portion, which is your too much money and not enough product. And we already are kind of starting to see that. I don't know if anybody has kept track of things like building materials, lumber prices. They had skyrocketed, and probably a lot of it due to the fact that in the places where people are allowed to go to, the Home Depots or Menards or Lowe's or any of your local hardware stores or something like that, people were buying up goods because they were working on their homes, because there was nothing else to do. And because most of our lumber, I believe, still comes from Canada, and they had closed the border, we only had the supply that was here, and not really enough supply for everybody else, so prices begins to go up and rise. I was going to say something on that. Global trade, but I'll talk more about that at a different time. I'm kind of covering a lot of topics here now, I think, and I'm hoping I'm still staying on a line where people are able to listen and follow, because I'm trying to get to a position here as I move along. But my next point, after seeing reduced supply of goods and having the price go up, and of course that's inflation as well, not just the expansion of credit and money, but hyperinflation. Okay, now I'm going to explain this how I view it, because I've never really had anybody give a really decent explanation of why it exists or what happens. Let's jump to, and it all, once again, it all has to do with demand. So it's just a little bit different, and I'm going to cover a little bit of the concept of global trade here, and then I'll probably go into another episode deeper into that. But when a company produces goods and they're going to ship their products to another country, they're doing exports, that other country doesn't purchase the goods in their currency. That country has to exchange their currency for, say for dollars, for example, to buy the goods that are being exported from the U.S. Because, I mean, companies here, they're not going to use somebody else's currency. They're taking on the chance that currency might devalue by the time they get it and are able to exchange it. So they want to make them do all the exchanging. They have to demand and make arrangements to get dollars and then pay. And vice versa, the same thing. If we're importing goods from, like China, for example, we have to get the Chinese yuan or renminbi, whatever you want to call it, and make payments in their currency for their stuff. and this whole concept still works on demand, because just like in the terms with lumber, where the lumber was becoming shorter in supply and the price was going up because of the demand, it's the exact same thing for currencies. So if we're doing a lot of exports, or somebody really wants whatever we're exporting, whether that's goods, services, it can also be financial assets, which oftentimes that's what we have in our treasuries. But they need our dollars. Well, that creates demand for our dollars, and people have to exchange for our dollars. And that demand keeps our dollar stronger, because it's causing a demand. And if our supply doesn't increase, the value of that dollar goes up. If our supply increases, it keeps a nice steady level value of the dollar, and that's your dollar index, if you pay attention at all or listen to any of those kinds of things. And it's the same for any other country. If we need Swiss francs, or we need euros or something like that, that's the same kind of demand. And so when you're working out trade with another country, that's where your foreign exchange goes. Like for example, the U.S. to euros, our trade determines where our ratio is with the euro. However many dollars they need, and however many euros we need. And so you look at this on a huge scale, and all these different currencies are being interchanged and then used to purchase goods or purchase treasuries from other countries or anything of that sort. And that's where all your exchange ratios come from. And so that kind of gives you an idea of that whole demand aspect for a currency and how that is valued. Now, let's go into hyperinflation. We're going to use Weimar Germany for an example, because a lot of people bring Weimar Germany up when they discuss this. And so if you look, it's a unique case, but I'm fairly certain, I didn't really look into, I believe it was in Zimbabwe where it had occurred, but it's follows the exact same thing, I'm quite sure, in terms of demand. But in Germany, it was right after World War I. And so the Allies broke Germany up into bits and took different portions of Germany. And they were their productive portions, whether it was forestry or mining or manufacturing or whatever. They took over those sections, and they took whatever goods were produced, kind of in terms of payment for the war that had been started. And on top of that, what they did was charge Germany basically a reparations payment that was due to all of the Allied forces that had fought against him. Now, if you think about that reparations payment kind of as a debt that was owed to everybody else, it's similar to how our treasury bills would be, where if some other country purchased our treasury bills, we have to pay on those. So it's kind of it's a similar concept in terms of cash flows going in and out of the country. Now, they had done a couple of different raises of what they determined Germany owed, and it kept increasing, kept getting bigger. They kept kind of squeezing down on the productive assets of Germany. So this kind of worked this way. But in essence, what happened was Germany didn't have any assets to export that were worth anything. So there was no need for any other country to get the marks. And there was no need for any country to use these things because there was nothing from Germany they needed to purchase. Like I said, they already took over their manufacturing, their forestry, and so on. And there were some uprisings and such that had to be dealt with. But if a country isn't exporting anything and nobody needs their currency, the currency doesn't have any value to anybody else because it's just a fiat currency. There's nothing that they're exchanging it for. The only reason why a country needs some other country's currency is if they can exchange that currency for some tangible good or a service. And so that's what Germany ran into, was the fact that nobody needed any of their money. But what happened was they couldn't make their payments on the reparations that they were charged. They couldn't make their debts. What they did was just simply print, and then they gave them that money. Well, that money wasn't worth anything to these other countries, so they're like, well, no, we're not going to take this. And so for all of the imports that Germany was trying to bring in, same kind of thing. Germany was trying to exchange their worthless currency because it wasn't good for any other goods and change it into other people's currencies so they could buy their goods to import. Well, it wasn't doing them any good. They couldn't make any payments for anything. Their currency was literally worthless. And that's with fiat currency. It's only good for what it can exchange, as something useful to you. People view cash as like something great. And it's like, yeah, it is, except for the fact that if it ever comes to the point where you cannot purchase something with it, it does you no good. It's just paper. And that's exactly what Germany was finding out. In fact, it was in mid-1923, like June or July, I think the valuation, if I remember when I looked it up, it was 600,000 marks to $1. By the time it hit November, it had gone to like 1.2 or 1.4 trillion marks to $1. It had jumped that much. It had become that worthless. And so how did they fix this? Well, they had fixed it by developing a brand new currency. But mind you, this currency was a collateralized currency. It was backed by all of the mortgages of all the leftover mining and agricultural deeds that they had that hadn't already been taken by the other countries. And so it was backed by payments from something, some goods. So this currency, if you wanted to exchange it for something in that way, probably like coal or something, you could have done that. This was a collateralized currency. It was backed by something, and it gave it value. And it's not actually all that different from having a gold-backed currency, actually. But that's what saved their currency. They then took this new currency and then they exchanged it for their worthless fiat currency. And I forget what the exchange rate was, but a million of their marks for one of these currencies or something like that. It was probably worse than that. But finally they had something that was backed by something tangible, and the other countries were like, okay, all right, so now we're going to ease up a little bit on some of this stuff, and they did. And some of the other countries finally started giving small amounts of credit to the country, and by having small amounts of credit, kind of just building back up their faith in the payments, and some of their industries were now able to start producing again for exports for the country. And that's kind of where they stabilized a little bit, and then they finally had another currency after that, and they became the Germany right up before World War II, actually. So, I mean, if you want to go really deeply into whether that worked or not, you can research that. But on the concepts of the financial aspect and where the currency came from and where the hyperinflation came from, it came from the fact that eventually there were no exported goods that were of any use for any other country to need their currency. And if it comes to the point where your currency is no longer needed by anybody else, all of the currency that's gone out is going to all come back to you because they can't buy it for anything. And they're going to try to exchange it for whatever they can tangible. And that's your hyperinflation. That's where it comes into play, because you're then trying to use that to purchase goods for import, but nobody wants your currency. It's worthless. And in a consumer-based economy like ours, that can be really bad. Our dollar has always been considered a safe haven, and obviously is used for purchase of oil and for all purposes that you're taught through finance. The Treasury is a securely, backed and safe asset to invest in. Most of these countries had been perfectly willing to purchase treasuries just simply because then they could swap them out for dollars. And since everybody needed dollars for oil and a lot of financial products, because our financial institutions were bigger than anywhere else in the world, they kept them on hand. A lot of folks don't necessarily know those treasuries are what's called monetizing our debt. And I'll kind of end on this point because I'm running up here on the hour mark. But those treasuries are called monetizing our debt. And to go back to the credit card situation, if you get a line of credit card with your family or something like that, they usually tell you have $1,000 limit, $5,000, $10,000, whatever. So our treasuries, and every time you hear the debt ceiling come up, that's taking that $5,000 and that say you just maxed it out and selling it to somebody else and saying, hey, you know what? If you give me that $5,000, I'll pay you interest on that. That's what your credit card company is doing. But that's what the government is doing with these other countries, saying, hey, we're going to spend above what we're actually producing, but we're going to pay interest on that. We'll pay you interest if you buy that for that debt. It's credit cards that you're getting from other countries. And then, of course, your debt ceiling is supposed to be the level at which your credit card is topped out at, but then they vote to extend the credit to themselves and keep spending. That's the simplest analogy I can kind of throw out for that, but hopefully you kind of get that aspect. And so I hope some of that flowed okay and made sense. I'll probably go a little bit more into the demand concept, but current state of our economy, a little bit about hyperinflation, and then maybe a little bit about treasuries and debt spending and how bad that is. Because if you keep doing that, just like your household, everything topples, and that's where we're at right now. But I'm at the hour mark, and so hopefully that wasn't too convoluted. I'll expand a little bit more into current circumstances and other things that maybe businesses can do aside from just downsize and search for actual potential areas of demand, and maybe even have to create new products or services that maybe they weren't initially intending to stay in business, and kind of keep the economy afloat. And then possibly what has to happen in terms of our currency, because the entire world is suffering from this circumstance, and some kind of system has to come into play in order to fix everything. Otherwise, this is going to play out like a hyperinflation on a global scale. And it's not funny, because the repercussions will be terrible. But unfortunately, with these currencies, that's kind of anything fiat that's not tied to something, that's the risk you run. So anyway, hopefully I relayed something to you, but thanks for listening.